All right, settle in, folks. Welcome back to Daily Market Narrative, where we try to make sense of the financial world without needing a decoder ring and a strong drink, mostly. Today, after the much-anticipated Jackson Hole soiree, the market's humming a new tune. It's a risk-on melody, apparently. Corporate earnings are apparently still robust, which is nice for them, and those nagging worries about the consumer suddenly being weaker than a wet paper towel have been politely escorted out of the room. The big takeaway? It's now a foregone conclusion, a done deal, a done and dusted certainty that the Fed has hit the big red restart button on rate cuts. No need to second-guess that, right? Now, let's dive into Dave's take on this whole risk-on fiesta. On the bull side, you've got this narrative screaming that the Fed's pivot is real, like a unicorn sighting, or a politician keeping a promise. The strong earnings are the icing on the cake, proving these companies are still printing money faster than a Las Vegas slot machine on a Saturday night. Plus, if consumers aren't about to suddenly start eating cat food, then maybe the economy isn't teetering on the edge of a cliff after all. It's a comforting thought, like finding an extra fry at the bottom of your fast food bag. But, and there's always a but in this game, isn't there? The bears are grumbling that this optimism is built on Jenga blocks stacked precariously high. They're whispering that maybe, just maybe, this risk-on is just the calm before another storm. What if those earnings are a mirage, a final burst of energy before the tank runs dry? And as for the consumer, well, they've been known to surprise us, usually not in a good way. This whole rate-cutting certainty, it feels a bit like booking your vacation before you've actually confirmed the flight details. Still, for now, the party's on, and nobody wants to be the one to turn off the disco ball. All right, let's get our crystal ball out and check the squiggly lines with our technical check-in. So, the SPY ETF, our trusty barometer of, well, something, is looking pretty spiffy on the higher time frames. It's in an uptrend, which is always a good look. And ever since Chairman Powell did his whole Jackson Hole shtick, even the daily chart seems to have found its mojo. Now, if the SPY decides to grace us with a couple of closes above, get this, 645, yes, you heard that right, 645, then the next logical stop, according to these magical lines, is a breezy 665. Of course, because this is the market, and nothing is ever that simple, we've got some crucial support levels to keep an eye on, namely 640 and 620. If we dip below those, well, the party might get a bit awkward. It's amazing, isn't it? Trillions of dollars dancing around based on whether a line goes up or down. Truly a testament to something. Now for the news that actually matter, the headlines that matter. First up, we've got default warnings start to pile up in the private credit market. Apparently, this whole private credit scene is starting to look a bit like a leaky boat. More companies are flashing warning lights suggesting they're in a bit of a pickle. The market impact? Expect investors to get a tad more skittish, which could mean loans get harder to get and more expensive. So, if you're a company relying on this stuff, maybe start packing a lunch. Next, Nvidia asks suppliers to halt H20 work, information says. Nvidia, the AI chip darling, is telling its suppliers to put the brakes on the H20 chip, the one they tweaked to get around US export rules for China. This is big, folks. It could mess with the AI hardware supply chain and potentially slow down AI development in China. On the flip side, it might just be a golden ticket for Nvidia's competitors. Then we have mail carriers pause U.S. deliveries as tariff shift sows confusion. Apparently, the government's tariff tinkering has made a mess of things, so much so that mail carriers are hitting the pause button on some deliveries. This is a classic case of unintended consequences, leading to delays and potentially higher shipping costs. It's like trying to assemble IKEA furniture with instructions in Klingon. Moving on, a headline we've already touched on but is worth repeating, Treasury yields fall as Powell signals Fed rate cuts could come soon. Yes, the market heard Powell, yields dropped, and everyone's feeling a bit more chipper about borrowing. Cheaper borrowing is usually good for business and consumers, and it pushes investors towards riskier assets. Makes sense. Then a bit of tech drama. Elon Musk asked Meta CEO Mark Zuckerberg to join xAI bid to buy OpenAI. filing shows. So Musk, the guy who likes to shake things up, apparently tried to get Zuckerberg in on his plan to buy OpenAI. Imagine that boardroom meeting. This could seriously shuffle the AI deck, creating a megaforce or just a really awkward tech feud. Speaking of awkward, Britons turn most confident about their own finances in a year. Brits are feeling good about their wallets. This increased confidence could mean more spending, which is generally a win for the economy, and, you guessed it, retail and services. Moving on, U.S. farmers facing double whammy of trade war and bumper crops. Our agricultural pals are getting it from both sides. Trade wars are messing with exports, and a massive harvest is driving down prices. It's a tough gig, potentially meaning lower food prices for us, but financial pain for the folks growing it. Might need some government handouts for that one. And now for our A Look Ahead segment, where we peek at the economic calendar to see what might make us spill our coffee. We've just come off the big one, the United States Jackson Hole Symposium, where all the central bankers gathered to, well, talk. And the main event from that was, of course, United States Fed Chair Powell's speech, which we've already discussed at length. He hinted at rate cuts, and the market went wild. Looking ahead, it's a bit quieter on the big policy announcements, but we've got the United States Baker Hughes total rigs count and the United States Baker Hughes oil rig count coming up. These are basically weekly snapshots of how many oil rigs are drilling in the U.S. More rigs usually mean more oil production, which can influence oil prices. So, if you're invested in anything energy-related, these little numbers might be worth a glance. So, to wrap it all up, the narrative is decidedly rosy, with rate cuts on the horizon and strong corporate earnings. The charts are pointing up, and even consumer confidence is perking up in some corners of the globe. But remember, the market loves a good story, and this risk-on tale is still being written. Keep your eyes on those headlines, those squiggly lines, and for goodness sake, don't forget to check if your own finances are ready for whatever comes next. That's all for us today on Daily Market Narrative. Stay invested, stay informed, and try not to spill that coffee. We'll see you tomorrow.